COVID-19 brought the world to a standstill. Nearly 2 million lives lost. The global economy paralyzed.
We anticipate the worst economic fallout since the Great Depression.
The pandemic is changing the way we live and work. While the virus rages, violent mobs stormed the U.S. Capitol, threatening democracy. And in Europe, Brexit ushered in a new era. But a new year and an unprecedented global vaccination campaign are offering hope. What will the year ahead look like for our society and economy? Will the travel and hospitality industry recover? Can technology unite us instead of dividing us further? We convene the biggest names across finance, economics, technology, and public health to create a blueprint for a future that's more resilient, sustainable, and equal. Join us for what's next at the Year Ahead Summit.
Hello, welcome to the Year Ahead 2021. I'm Mark Miller, the global editor of Bloomberg Live, and I'm excited to be your host for day 3 of our summit. At the Year Ahead, we are bringing together leading CEOs and global influencers from a range of industries, retail, travel, finance, healthcare, technology, to map out a blueprint for global businesses and their leaders as the world recovers from this pandemic. You've heard from many of them already, and we have another day of incredible conversations lined up. But before we get started, I have a few housekeeping announcements. I would like to acknowledge the support of our sponsors, Alex Partners and IBM. Tech issues. If you experience any tech issues with audio or video quality, try refreshing your browser or use the chat box in the bottom right-hand corner of your screen for support. We definitely want you to engage with us on social media using #TheYearAhead and engage with other attendees in the event chat in the bottom right corner of your screen. And now, let's get started for our first session. I hope you enjoy the year ahead.
It is Bloomberg, the year ahead. You think about 2020 and the year behind. 2021, what is it, 20-some, 30-some, 40-some days into it? It has been an adventure. For our institutions worldwide, it has been extraordinary as they adapt and adjust. Kristalina Georgieva is the managing director at the International Monetary Fund, and she brought to the institution a multiple decades history of adapting and adjusting. We're thrilled she could join us for her 2021. Dr. Georgieva, thank you so much for joining Bloomberg today. What I really want to talk about first off is your theme that game theory is not about individualism, every nation for itself, as Ian Bremmer would talk about. We need to get into this together, get through it together, and get out of it together. How can the IMF assist?
We are bringing our 190 members together last year to come up swiftly with the right policies for this very unusual crisis, and this year to march together for the recovery from it. There is good news. We now have vaccines, and monetary and fiscal policy have done their job to put a floor under the world economy. But we also are under the thick clouds of uncertainty. And what we look into for the next year are, first, the race between a mutating virus and multiple vaccines. Second, the resolve of policymakers not to withdraw support prematurely. We have to see the health crisis in the rearview mirror before we do that. And three, a re-energized global cooperation so we can vaccinate people everywhere as fast as possible, and we can bring the global economy up
Right.
for a more profoundly effective recovery rather than the uneven recovery, unfortunately, we foresee.
I think, Dr. Gorgieva, my good friend David Malpass, now at the World Bank, would suggest you are more qualified than anyone in the world to understand the systems analysis, the processes of, say, the World Bank or the EU, and now at the IMF, of getting the job done. What are we not doing right now that we need to turn around and do correctly?
But the very first we need to focus on is a recognition that vaccine policy is an economic policy, and that only vaccinating everybody everywhere would get us out of the risk of this mutation that we have already seen threatening the hopes for accelerated recovery. And that is possible. Not only it is possible, it is in the interest of everyone. We did a calculation at the IMF that if vaccination is indeed accelerated around the world, we would get $9 trillion bigger global income, and that $9 trillion between now and 2025 will be split 60-40 between emerging markets, developing economies, and the advanced economies. So it is a great value for money action from advanced economies to give a helping hand to the developing world.
You've got
and
such
the second issue...
No, please, go ahead. Please, Dr. Gorgieva, go ahead.
And the second issue that we need to zero in on is something that I'm very, very concerned about. It is a growing divergence within countries and across countries. What we see is that parts of the economy, high-tech, digital, no-contact manufacturing, is doing extremely well, and people there are flourishing. And parts of the economy in the contact-dependent sectors, low-skilled workers, women, young people, minorities, they're doing very badly. When you take this problem globally, advanced economies are pulling out of this crisis much faster. Poor countries are falling behind. Tom, for the first time in decades, poverty is going up, hunger is going up. 50% of the developing countries that used to converge in income levels are now diverging. In other words, they're falling behind. So why we should worry about that everywhere? Because we count on developing economies for dynamic growth. If they don't grow, bad for people there, bad for the world economy.
Kristalina, what I think is so important here, and I really want to draw the attention, the specificity of the IMF research of the 45 nations of Africa. I would suggest the data, cases, deaths, hospitalizations, just societal effect in Africa is the story for 2021, for February, even for June or July of 2021. What do we need to do to assist a poorer Africa to come to a constructive outcome?
We have 3 levers, and we can act upon using each and every one of them. The first one is to recognize that, unfortunately, infections are going up in Africa. Yes, youthful population, but they're also impacted. And we saw the South African mutation of the virus a threat globally, not just for South Africa and Africa. Making sure that we have vaccines accessible and that health systems in Africa are being reinforced so they can deliver vaccination, because a vaccine shot is only good when it makes it in the arm. And that means nurses and doctors' transportation capacity. So this is number one, prioritize support for health systems and vaccination in Africa. Two, recognize that the African economies are severely impacted by the economic crisis. Tourism-dependent, oil-dependent economies, especially severely. The numbers are really staggering. This year, 21, we expect Africa to grow only just slightly over 3%. When we project for the rest of the world, 5.5%. Last year, Africa shrunk for the first time in decades, 3% reduction. Now, why that should bother us? Because Africa should be growing 6, 7, 8, 10% to pull people out of poverty, to create conditions for more security. So we need to think of more grants and more concessional finance for Africa, and also work harder to make it so that low interest rates in the rest of the world make it as financial flows at low rate in Africa. And three, and
I think it's so important here to ask the obvious question, Dr. Georgieva, which is, where is the financials and the cash call right now to assist Africa and, frankly, to assist the rest of the world through this natural disaster? I look at the 4 years that you had with President Trump, and now you have a massive change, I would respectfully suggest, in Washington with President Biden. How do you feel about going to world leaders and saying, this is the Georgieva theory, this is what we need to do, give me a multilateral check? Is a check in the mail?
I actually feel fairly optimistic because there is this revitalization of global cooperation on the horizon for two reasons. One is because the pandemic has made us all more sober about our interdependence. And second, because we do have a very strong signal from our largest shareholder, from the United States, that we are going to work more together, from climate to helping developing countries in this crisis. Last year, we made the call to our membership to massively increase our concessional lending capacity, and the membership, for fairness to all, responded to this call. So we have provided financial lifelines to 85 countries. 49 are low-income countries. We actually were there for Africa. Tom, I got calls last year from leaders in Africa. They would express such deep appreciation for the speed and the size of the financial support we provided to these countries. This year, you asked me what is the Georgieva call for 21. My call for 21 is lean forward, we have to do more. We ought to look into ways in which we expand further the concessional capacity of the IMF. We are engaging with our members on that. It means to get more special drawing rights that are already in existence. There are some that are on the view that going for additional SDR allocation would be timely, and I see this as a possibility to be explored. Why? Because new SDR allocation provides extra liquidity to countries that have no access to markets. Those who are questioning the validity of a new allocation say, wait a minute, 60% would go to countries that don't need it. But at this point of time, I think we need to concentrate on the benefit of increasing capacity of poor countries to cope with this once-in-a-century pandemic once in a lifetime economic crisis. And if I may, my third point, I said we have three levers. Let me go to the third one, which is debt. Many African countries are under a mountain of debt. It has gone up since the beginning of this crisis. Thankfully, the G7, the G20 have advocated for action, and now we have debt service suspension for low-income countries. But it expires in April. So my plea is for us to look for ways in which we can expand the space for these countries to cope with the crisis as a priority. The same way we say in advanced economies, now is not the time to think about debt, interest rates are low, make sure that you protect your economy and your people. We have to do the same for poor countries.
And Dr. Georgiev, in the time we've got left, in a good 6 minutes that we have left with you, I think it is so important not to dovetail what's going on within market shocks within the United States or this, that, and the other thing, but this unique economic experiment of a massive central bank accommodation and the new fiscal economics of this natural disaster. And I want to go back to your MIT economics of years ago, where you dovetailed environmental economics into the traditional classical, neoclassical economic response. Do we know where we're going with this massive accommodation and with this massive fiscal buildup?
What has been done over this last year was the appropriate policy response to this very unusual crisis. We asked the economy to stand still, producers not to produce, consumers not to consume, and to be able to survive, to prevent massive bankruptcies and unemployment. It was and it continues to be appropriate to have accommodative monetary policy, low interest rates. They're going to stay low for some time to come. And then use these low interest rates also for some fiscal expansion that has given lifelines to businesses and has protected the most vulnerable in society from a real severe harm. Now, when we look forward, there are two very important lessons we need to take with us. The first one is that accommodation needs to continue, but there would be time when good news will translate into less support, gradual withdrawal of this support, and we have to be ready. We know that last year the bankruptcy rates were lower than historically they would be. So we would see some companies exiting, and we have to make sure that our banking system, our supervisory authorities are ready to prevent this from being damaging to the economy and to society. And then we need to say, okay, as we continue to provide some support, can we target it better for the dynamic growth of tomorrow? And the answer is yes, we can. We can support a green investment push that would reorient the economy. So on the other side of the crisis, it is greener. Hopefully, it is also more equitable economy. That green investment push is going to generate also growth in the jobs that are necessary to compensate for automation and for the impact of the crisis. The beauty of green is that it can be job rich. Reforestation, buildings, renovation to reduce emissions. All of this is good for jobs as it is good for growth and it is good for our planet.
And then as we close out here, Dr. Georgieva, then I have to ask the tough question here is what leadership can the IMF provide to the great polluter China is they desperately want to be green? There's no question. We've seen it in all the books that are out there. Dan Yergin's book, The New Map, was my book of the year last year. All of it's great, except we've got to get China on board with the Biden administration to begin to solve the pollution of the Pacific Rim. How can the IMF affect that?
By engaging with China through our Article 4 consultations, concentrating on mitigation, reducing carbon emissions, and concentrating on carbon price gradually increasing to provide the incentive for businesses to change from brown to green, and also by engaging globally on this topic of shifting towards the new climate economy, so countries that are interacting with China choose this right path that is a win-win-win-win. It's good for growth, for jobs, for health, and of course for our planet.
I've got 1 minute left.
We are embracing that.
I know you're embracing that. I want to embrace a difficult question. I want you to speak right now, Kristalina Georgieva, to a significant part of the public that's not anti-vaccine, but they're afraid to get that first shot. They're afraid to get that second shot. What has the IMF learned about the courage needed to get out there and get the vaccine?
First, I got my first shot. I will soon get my second shot. Acting on my belief just in front of you today, but also to recognize that unless we put this crisis, health crisis, to bed, we are not going to see our economies and our lives to go in the direction we dream of. You want to hug your children, you want to hug your grandchildren. Let's put this crisis to bed.
Kristalina Georgieva, thank you so much for joining us. The Managing Director of the International Monetary Fund of Bloomberg, the year ahead.
Well, hello, I'm Stephanie Flanders, head of Bloomberg Economics, and we're going to virtually cross the street now in Washington, at least institutionally, to talk to Dr. Carmen Reinhart, who was already one of the most influential economists in the world, even before her current job, through her research on government debt and the long-term implications of financial crises through history. But now she's in pole position as chief economist of the World Bank since last summer. Dr. Reinhart, Carmen, very good of you to join us at Bloomberg the year ahead. Let me get straight to the point of this year's recovery and what we're looking at. We've maybe a few weeks ago even, the world was quite optimistic about the kind of pace of growth we might see this year, a lot of demand pent up from last year. Now, around the world, concern around new variants, new question marks over the rollout of vaccines, great concerns about that process in the developing world. Are you looking fundamentally at a more somber picture when you look at 2021? Or do you think we could still see a decent recovery?
Well, I began to have my doubts about what was the prevalent view earlier in 2020 that this was going to be a V-shape. Again, very different technology, very different world, but you go back to the Spanish influenza, and that kicked off in April of 1918, and circled the globe several times till 1920. So my expectations of recovery were always on the halting side. I think increasingly I am concerned that the damage that has already transpired will also be a headwind to a faster recovery. And, unlike the 2008-2009 crisis, This one is really global. The 2008, 2009 was really about a dozen of advanced economies that had bubbles in real estate and financial excesses. This is much more fundamental, much more broad-based. So I think I'm not looking for a quick recovery. And I think what my overarching message, this is with work that I did with Vincent Reinhart last summer for Foreign Affairs, don't confuse rebound with recovery. True recovery will take longer.
Well, I was very taken actually with the Global Economic Prospects report that came out from the bank this week did have a very somber tone, I thought, and the reference to many countries losing a decade or more of per capita income growth. And that's something that you have rightly focused on, what happens to income per head, not just the overall GDP. The divergence that we're seeing between developing and developed, there's a conversation around the K-shaped recovery that has taken the place of that V-shaped recovery. We talk about it in terms of inside economies, one group doing much better than the other. But do you fear that there's also going to be a global K-shaped recovery when you look at the prospects for developing countries versus advanced?
Well, indeed, one of the many concerning facts of this crisis is how unequal. It's a very regressive shock. It's regressive both within countries, both within countries in the sense that lower income households and smaller firms have taken on a disproportionate hit. It's also very unequal across countries, where, the poorest and even considerably into the middle income haven't had the ammunition, the capacity to do the kind of counter-cyclical fiscal stimulus, the transfers for social safety nets, the spending on health that the advanced economies have done. And again, by contrast to the 2008, 2009, after 2008, 2009, what we saw, if you look, for example, at credit ratings, you saw the credit ratings of emerging markets go up while the credit ratings of the advanced economies went down. Now the wedge between the two is getting bigger, and it isn't because the advanced economies are being marked up. So it's very unequal impact globally as well.
And just in terms of how the international community can respond to that, I mean, you've pointed to in past interviews the lack of firepower, relatively speaking, that the World Bank and the IMF have to combat this inequality and this liquidity issues facing many developing countries. Of course, one thing that's been talked about as a response to that is an issue of new special drawing rights from the International Monetary Fund. I mean, is that something that you support, and is that something that you think is now more likely with this new Biden administration?
Starting from your last question, yes, I think it is more likely. Look, I think that the IMF, the World Bank, the multilateral banks have really, if you look at the volume and the reach of their lending in terms of number of countries, 2020 was an unprecedented year. So you try to lend as much as you can into an emergency like this. At the World Bank, within that lending, there's great focus on targeting social safety nets, precisely because of the issue that this is a very a crisis associated with increasing inequality. There's also been, of course, the initiative of the G20 to the DSSI, the debt suspension initiative, to allow countries to temporarily redirect funds that would have been used to repay debt to redirect them towards emergency spending. But even with new lending, even with the temporary debt, suspension initiative, you still at the end have countries that uh, many of them were already frail, okay, prior to COVID. And those fragilities have really been increased because it really, if you look at many of the countries that are in most dire need right now, where we've seen per capita incomes fall more than 20%, like Angola, many of those countries were very much hit by 2015 by declining commodity prices, by the slowdown in China. So they were already in much weaker conditions, and there are indeed limits to what new lending and these temporary debt initiatives can do. I think what we're going to move to is, albeit I think slowly, is more debt reduction, more debt forgiveness. I think that's the next stage of the process.
So just to be clear, I mean, I want to get onto that, but you want to focus more on that. You think there's more traction to be got through that framework than through pushing on the SDR, or do you think you should do both?
No, they're not mutually exclusive. They are not mutually exclusive by any means. I think more firepower to the lending is more of a short run response. The more permanent reductions and restructurings of some of these countries that are in need, some of those debts, that's more a medium term. It's seldom achieved quickly. Let me put it that way. Historically, debt restructuring takes time. We hope it takes much less time now than it did in the past, because that's the whole setup for lost decades and so on. But by no means am I suggesting that the two things are mutually exclusive and would work well as complements.
Do you think that the SDR thing could happen in this year, in the next 12 months, or is that pushed off?
Look, certainly, so much hinges on the success of vaccines in terms of the potential for a recovery. I mean, you mentioned, we have our forecasts out there saying growth is about 4%, but look, if the dispersion around that is significant. You could see significantly higher growth if everything goes very smoothly in terms of global distribution of vaccines, or you could see less than half of that if the process is bogged down and doesn't quite have the speedy outreach that is hoped for. So in especially with renewed surges in infections and new variants of the virus, now another fresher source of concern, I could see the political willingness and international cooperation that could lead to moving in the direction of another allocation for this year. Yes, under these conditions, it's possible.
Well, that's certainly chastening for people to take on board that you think that the growth rate for this year could that forecast could halve, given if we see a continuation of the kind of problems that we've had. On that common debt framework, I mean, clearly the key thing about that G20 agreement at the end of last year was the inclusion of China and others in the same framework, countries that were outside the so-called Paris Club. You've had Chad now be the first country to apply for restructuring under that framework. Are you expecting many more countries to join? And would that be a success to have ironically, a success to see as many countries as possible use that framework rather than fight restructuring?
So, look, success is, when you're dealt with a bad hand, a quick response and quick correction is the preferred outcome, is not the outcome you would have chosen. You would have preferred not to be dealt a bad hand in the first place. But given that, as I said, a number of countries already started pre-COVID with very vulnerable external debt positions. So getting to the core of the question is Chad, a sign of things to come. Look, I am not looking for the kind of tidal wave that we saw in the early 1980s. Okay, and I'll explain briefly why. But we are looking for numerous, especially among some of the low income, highly indebted. Besides Chad, we have the case of Zambia. There's a question of Ethiopia. There are many others that would benefit from a faster debt resolution through the common framework. But the reason I said, I just want to go back to that I don't expect the tidal wave that we got in the early 80s is in the early 80s, we had a spike in US interest rates, where indebted countries saw their debt service skyrocket literally overnight. Here we have, given the low for long, we have an environment in which debt vulnerabilities are playing out at a slower pace, but they're still playing out.
Well, we have some questions in, and I just want to remind people that you can put your questions into the Q&A. One of them goes to something which has obviously been a big part of your academic work. It says, should governments maintain the same mindset towards spending and borrowing after the pandemic? Now, we've had, I would say, an officially a very relaxed position around government borrowing overall in response to the pandemic. And indeed, Kristalina Georgieva, who we just heard, whenever I've spoken to her, for someone who's the head of the International Monetary Fund, who's been very relaxed, very concerned about the risk of spending too little, not spending too much. Do you see a change in that mindset needed over the next few years, or do you think that that really is a very low-grade concern, the fiscal borrowing and levels of debt?
So look, let's not extend the horizon to the next few years. But certainly, I think the way, and I've reiterated these remarks in several contexts, I think the way many policymakers, I don't want to put words in Kristalina's mouth, but certainly also the way I view it is this is a war. It has the human cost, the cost to the economy, the cost to every development indicator almost that one can think about. It has been, off the charts in terms of relative to any kind of business cycle or financial crisis you want to compare it to. So how do you react in a war? Well, you worry about winning the war, and then you worry how you're going to pay for the war. And one of the concerns that I laid out last summer in this piece that I mentioned with Vincent Reinhardt is there is the risk that people, policymakers confuse rebound with recovery, which means you're really back to your pre-crisis per capita income, and tighten too quickly and declare victory prematurely. That scenario is a real source of concern. So, it's not that I embraced, high levels of debt. I don't take a benign view of having high levels of indebtedness, but I think the priorities is you first win the war. And we're still in the thick of it.
I know we're going to maybe, I hope, have time for two more questions, so I'll try and do it briefly. But it's been such a somber and appropriately somber interview. I wanted to try and tease out maybe a little circles of light. And one of them, if you look in the financial markets, obviously there's quite a lot of exuberance around the productivity improvements that could come from COVID, forcing companies to do things differently, forcing individuals to do things differently, changing supply chains, all of these things. Is there a part of that story that could also apply to developing countries? Is there any silver linings that you see or opportunities you could seize?
Look, crises, because they disrupt the very core of the economy and the way we work, the way we think, can lead. And I mentioned wars. By the way, wars have been, not exactly the way one would like to go about it, but wars have been period of a very intense technological innovation. And in this case, I think one of the fallouts that I'm on the positive side is also when you look at globally the amount of medical research that has been, brought to bear during the COVID pandemic. And one thinks of positive externalities that concentrated effort in medicine that we have seen in this crisis. I think we can't really measure what some of the benefits that may come from that. But, look, I think, one can say very little at this stage. I think there's still a margin of uncertainty on, what the new normal in terms of productivity, in terms of potential output is going to look like. And, I don't want to be a wet rag, but I think before we get to that silver lining, I think the emerging markets are going to have a very rough road. And we haven't even talked about some of the financial fragilities that I see evolving because the longer the slowdown, with new shutdowns, with tourism paralyzed, with, trade not as bad as we feared, but still weak by almost any metric. The effects of all of that on balance sheets of households and firms, individuals who have lost jobs, firms that have shuttered and cannot reopen, the effects of that on bank balance sheets is yet to be felt because we talk about monetary stimulus, we talk about fiscal stimulus, but one big source of stimulus and liquidity during this crisis has also been that banks and financial institutions have adopted forbearance and grace periods for households and firms to repay their loans. We don't know what awaits us when many of those grace periods come to an end, who will be insolvent and who will be illiquid. That's a risk still. So, we still have a rough road in the interim.
Well, Dr. Reinhart, you have given us plenty to think about, not all of it upbeat, but certainly serious and important. And you've also reminded us what a privilege it is for the World Bank to have someone with your historical frame sitting in that job as chief economist. Thank you so much for talking to us on the Bloomberg The Year Ahead.
Thank you. A pleasure.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Good morning, everybody, and welcome. I'm Eric Schatzker, editor-at-large here at Bloomberg, and this is The Year Ahead. Before we begin, I just want to remind members of our audience you can submit questions. We encourage you to, and I will do my best to work them into my conversation with the gentleman you see on your screen. His name is Eric Peters. He is the CEO and founder of One River Asset Management and One River Digital Asset Management. And Eric, you made headlines last month as the Bitcoin whale who surfaced with $1 billion of crypto holdings and the backing of Brevin Howard's Alan Howard. And that, as we all know, is one sure way to make a splash. $1 billion, that was when Bitcoin was priced slightly lower. How much do you hold in crypto assets now?
Hey, Eric, thanks for having me. And I would say that I would say we made headlines in that you broke the story. Yeah, we well in excess of $1 billion at this point.
Now, you've written a manifesto, The Case for Digital Assets. And that's where I'd like to begin, because since you emerged as the whale, Bitcoin has more than doubled to $40,000, and it has since pulled back about 25% to $31,000 as of this morning. The volatility is fine, I suppose, if you're a retail investor. What is the case for institutional investors to own digital assets now?
It's a good question, and look, our starting place is to think about what the right place to invest is, as opposed to what's the right place for institutional investors. And I think, you know, when an institution is looking at its portfolio, there's an issue of, you know, what's the appropriate size. But let's start with just the investment case. I think that you know, we are in a unique period right now. It's a very late cycle period that we've seen many times throughout history, and it's a period where governments become extremely indebted, monetary policy becomes less effective, and ultimately governments, in order to spur real demand in the economy, need to issue lots of debt and begin actually spending. And typically when they do that, they try to unburden themselves from the debt that they're incurring by debasing the currency that they're issuing that debt in. And so it's a very rational response to an economy that is late cycle and heavily indebted. The issue there is that ultimately those who hold that currency, you know, lose their spending power, and it becomes a difficult challenge to figure out how to at least hold on to that spending power. And there aren't that many assets in a world like we're in today, where things are so rich in terms of their pricing. Digital assets are really interesting in the sense that they're new. It's a new asset class altogether. And I think they have some unique qualities, part of which resemble the qualities that you'd find in gold, except that they're, I think, wildly underpriced relative to gold. And then they have another set of properties, which are properties that are technology properties. So Bitcoin, for instance, and this applies to other digital assets as well, but it's a technology platform, and it will look different tomorrow and next year and in a decade to come relative to how it looks right now. And that makes it unique to gold, because kind of gold has looked the same 2,000 or 2 billion years ago, and it will look the same in 2,000 and 2 billion years from now. The question is, what are these technology platforms, this new nature of money, what will that look like in 2 months and 2 years and 20 years? And I think you'd have to be a real pessimist to think that an emerging technology platform doesn't become more interesting, more useful, more valuable. So this entire asset class has these unique properties in that it helps, it allows you to gain access to the possibilities that these new technology platforms hold, while also helping mitigate this risk of monetary debasement. That's a function of kind of poor policy decisions that we've made in the past. And so it's very rare that you find an asset that can kind of allow you to capitalize on future upside while also mitigating the downside like that. So that's, I mean, we could spend a lot more time on it. I would encourage anyone to read, you call it a manifesto, it's paper. But I would encourage you to read that because I think it dives deeper into it. But at the core, that's really the argument.
Would you say, Eric, at the moment that your interest in or faith in digital assets has more to do with the first leg of the thesis, which I would call the macro leg of the thesis, or more to do with the second leg of the thesis, which is more about, the promise of technological innovation?
It really is a combination, Eric. But look, I've been a macro investor my entire career. I always start with the macro. I'm not at my core a technology investor. I've just watched the advance of technology over the course of my career. I've marveled at it. I think it continually astounds us in terms of where it leads us. And so I actually I have seen a whole range of the emerging second layer applications that will be built upon this technology platform, and they're super promising. I've seen enough to know that in essence, tomorrow is going to look better than today. And I think when you're investing, it's incredibly important. Does tomorrow look better, worse, or the same? And I think I've seen enough to just understand that tomorrow looks better than today in these assets. But my starting point is really macro. And we have been anticipating this late cycle activity where we advance fiscal policy, we really expand it. I think this pandemic has created an expansion that's in excess of what we or almost anyone would have imagined possible. The fact that it's co-joined with monetary policy at this point, in the sense that we're issuing enormous amounts of debt and we're having our central bank buy them, that's the dynamic that we have been anticipating. It's the scale of it is just so profound that that's really that's the driver. So the question is, in that environment, what are the assets that you can own? You can try to own equities, and a lot of people do. Those have not done well. Typically in inflationary periods, look back at the 1970s and you'll see that. You can own gold. Gold is, a lot of people own gold. Or you can own digital assets. And I think if you believe the things that we have seen and believe, then you look at them and you go, these are dramatically undervalued relative to some of these other stores of value. And so that's what makes us excited about these. It's just an undervalued asset for that macro backdrop.
I don't need to tell you, Eric, that crypto skeptics are everywhere. There are many to choose from, but I'm going to go with Jeremy Grantham, the legendary value investor. As you know, he's not a macro guy, but he raises a couple of pertinent questions. One is, how can you value anything that generates no cash flow? And the second is, if Bitcoin is 100% faith, a quality, by the way, that you acknowledge in the manifesto, in a bear market when investors retreat to proven safety and faith is at a minimum, Grantham asks, who will want to own something whose entire reason for existence is faith and nothing but faith? How would you respond?
It's a fair question. Here's the thing. You don't get to buy a cheap asset unless there are all kinds of reasons to be skeptical. It just is. It's just a reality, right? So, we could spend a half an hour going through it. We could probably spend 3 hours going through the case to be not to be skeptical, but to be concerned about owning anything that doesn't yield a cash flow, right? At the same time, gold doesn't. There are no cash flows associated with gold, right? Gold is worth an awful lot of money, as are a whole bunch of different equities that yield no cash flow or negative cash flow. And so, look, I think in many respects, my goal is not to try to persuade people that this is a wonderful asset to own. I think we've done the analysis ourselves. I think in a world where there is abundance of all things, we have a unique asset here in Bitcoin, which is it has limited supply. It's unlike any asset that I've seen in the world, in the sense that there's no supply response to the price. So if Bitcoin went up 5 times in value, or 10 times, or 100 times, there wouldn't be more Bitcoin produced. You can't say that about really any other asset in the world. Now, does that mean that it has to go up? It doesn't. But if we have collective faith that this is a store of wealth for people globally, and it's a whole new type of store of wealth, in the sense that it relies on people throughout the world having a collective faith in its value, then it can become incredibly valuable. And right now, what I would say is, if it were just to go up to the market cap of all the gold in the world, it would go up to something in the order of $500,000 per Bitcoin. Right now, it's trading at, let's say, $30,000, right? So if you look at it from a trader's perspective, there's enormous convexity to the upside. I think it will be worth more than gold at some point because gold is not infinite. Gold continues to increase in terms of supply. Bitcoin supply will go down over time. And in the history of the world, there will only ever be 21 million Bitcoin. So, that's it. There are all kinds of fair criticisms, and he makes a fair one. From what I've seen, there's enormous faith that's being built up globally in ways that I haven't witnessed in my career.
Were Bitcoin to be worth more than gold, as you point out, it would have to go up 20x or almost 20x from where it is today. How long does it take for that trajectory to play out? Are we talking about a 5-year timeline, a 10-year timeline? What's your best guess at the very least?
So the answer is obviously no one knows that, and I think it's policy dependent. So I've been in this business long enough to know that you need to think in terms of probabilities. You need to try to imagine the various potential futures. I would say the probability of the U.S. reversing its policy of trying to debase the currency that it's issuing debt in, the probability of that is virtually zero. So in order to imagine that, you'd have to imagine an enormous economic boom that allowed the Fed to step away from buying treasuries and allowed the Treasury to stop issuing lots of debt. Okay, I think that's highly unlikely. I think more likely we could see some type of next recession that is followed by even more issuance and more buying from the Fed. Now, I think that the politicians and the policymakers think that they can proceed with this large issuance and monetization of debt and debasement in a very gradual way. And if they do that, I think that the value of anything that protects against inflation will go up at a relatively measured pace. I would say that if they're wrong that they can do this at a measured pace, and it becomes and markets become disjointed, and people begin to lose faith at kind of a faster pace than they would want them to, then these assets are extremely convex. It could happen in a relatively short time. It could happen in a number of years, in a matter of a few years. But one of the things about these assets is you have this optionality to the upside. It doesn't cost you anything to hold them. You have price risk to the downside, but you don't have negative carry.
Can digital assets, will they appeal to institutional investors if they continue to exist in what I would call a parallel track to fiat money? Or do institutional investors need to see some kind of government or central bank acceptance or endorsement, for, as Mike Novogratz would say, for the cavalry to really come in?
Well, I would say that you've borderline ruined my life after having broken that story, because the number of institutions that have been filling my day with calls and inquiries about this is astounding.
So it's happening already.
Yeah, oh yeah, enormously so. Now, I think this is a. If I had to guess, I would tell you that this asset class will become, let's call it mature, in a decade from now. That's just a guess, because I think what's happening is almost every big credible institution in the U.S. is having discussions about this at their IC. Many of them are calling us and and typically if someone is calling us about our volatility products or our macro products, we'll have 3 people on a line. We have huge institutions where you have 10 to 15 people, the entire investment committee. They're fascinated by this. They should be, by the way, because this is the first and last asset class that will that will appear in our lifetime. And so if you're a large institutional investor, the first natural place to get exposure is the beta of these assets. And I think as One River, as a fiduciary, our goal is to provide safe and secure kind of peace of mind around how institutions get access to the beta of these assets. But the beta of these assets is just the beginning. They're going to be are going to be all kinds of opportunities in this asset class. And so it's very important for all of these folks, whether they allocate a significant portion or some modest portion of their portfolio to these assets. It's important just because you get to start learning about them. And so we are overwhelmed with that type of response right now. So it's virtually impossible to imagine that you have this level of interest and you don't have allocations. But I think those allocations, they're literally going to take years, and they'll start small and they'll increase in size over the next decade.
I mentioned earlier your partnership with Alan Howard. He, of course, is a macro legend. He co-founded one of the world's best-known hedge funds, Brevan Howard. What is the story, Eric, behind your partnership with Alan Howard? How did the two of you come together?
Yeah, I mean, Alan's an amazing trader and investor and kind of business person too. I've known him for the last decade. We talk macro markets a lot, exchange ideas, information, et cetera. We kind of explored something a few years ago, potentially doing something together, and it just wasn't really the right time. And he called me this late summer and just said, I think it's time for us to restart those conversations. Aaron Landy is his CEO, so Aaron runs Brevan, and so we all discussed kind of honestly, the best way that we can capitalize on the decade ahead, which we think will be extremely difficult for investors, and really bring the most value to our clients. And felt, One River is we're a macro firm at our heart, but we very much take a solutions-oriented approach to how we interact with our clients. So I'm a collaborator by nature, so we think a lot about how to work with our clients to help them think through their big problems and issues, and then deliver solutions to that, investment solutions to that. And Brevan is the greatest macro firm in the world, and so our view was collectively that we could be better firms if we worked to collaborate and help our clients think through the issues and deliver solutions to them. So they took a 25% stake in October, and it's been, and there have been all kinds of things we've been able to do together. It's a wonderful partnership, and it's great to work with both Alan and Aaron. And I think Aaron's vision for Brevan looks much more solutions oriented or partnership oriented with their clients. So it's that's how it worked out, and it was great because it's nice to know people for a long period of time and then be in business with them.
This event is called The Year Ahead for a reason, because we want to look into the future, and we've been talking a fair bit about the future, but let's talk about the next year. A year from now, January 2022, Eric, what do you think this digital asset landscape will look like? What do you think Bitcoin will be trading at? What will have evolved in the way of infrastructure and appetite for digital assets?
Well, I think that prices will be higher. I think that there will continue to be volatility, but ironically, there are all kinds of reflexive dynamics in these assets that ironically will lead to less volatility the higher they go. In terms of the higher the price goes, because what you're doing is, as the prices are going higher, you're drawing in new types of investors with stronger hands, quite frankly. And so I think over the next year, a lot of money will be drawn into these assets, and that prices will be higher. There probably will be volatility in the sense that markets always try to get ahead of themselves, or they inevitably get ahead of themselves. I think there's a lot of expectation of institutional allocation of this space. That will happen. It absolutely will happen. I mean, we're building one of the on-ramps, and I think will be the leading on-ramp for institutions to get access to this space. And so I think we'll have a good pulse on what those flows look like over the next year, but they're absolutely coming. I think that the regulators they play an important part here, and from our work and discussions, I think that they're most interested in making sure that this digital asset kind of foundation is firm. So you'll continue to see regulations come out that try to increase the transparency in this whole asset class, and I think that that's a good thing. That will what's happening right now is you're seeing these regulations come in not to destroy this asset class, but to really make it a firm foundation, because regulators understand that the future of finance will be digital. And so if they were to somehow really damage this asset class, what they ultimately do is they harm the foundation for U.S. entrepreneurs to bring innovation to the space of digital assets. And we'll see that to our competitors and our adversaries, quite frankly. So I think we'll see more regulation. I think there'll be push and pull. It will be sensible, ultimately sensible regulation. And I think that will lead to more flows in this asset class. I think what you'll also see, the last thing I'd say is you'll see more second layer applications and things built around these assets that will start to really kind of tease people's imaginations about where this can go. And so, as I said, tomorrow in these assets, tomorrow looks better than today. And so in a year's time, you and I will be having a conversation like this, and you'll be asking questions about, hey, how about that payment system that was built on top of Bitcoin? What do you think about that? No one sees that yet, but they'll see, in a year, we'll be talking about things like that.
Eric, it's been great to have you here at Bloomberg's The Year Ahead. A perspective that we don't often hear, right? You and your firm are on the leading edge of this sort of the way institutions are beginning to think about cryptocurrencies. And I encourage anybody who hasn't read it already to go to your website, One River Asset Management, and find the case for digital assets to understand better how you think about them. Great to see you, Eric. Thank you again for everybody who tuned in. In the middle, that is Eric Peters. He's the founder and CEO of One River Asset Management and One River Digital Asset Management. I'm Eric Schatzker in New York. Much more coming on Bloomberg's The Year Ahead.
Thanks, Eric.
Hello, I'm Gina Martin-Adams, Chief Equity Strategist for Bloomberg Intelligence, the research division of Bloomberg LP. I'm here to talk a little bit about the outlook for stocks. Global equities had a pretty great 2020, all things considered, but gains were still quite concentrated in the S&P 500 and specifically in large cap growth stocks. We anticipate that gains should broaden to other groups, and the S&P 500 should pass the baton, so to speak, to other areas of the global equity market in 2021. In particular, we see three areas of opportunity in the year ahead. Small caps, emerging market equities, and value equities all offer tremendous discounts relative to their counterparts in large caps, developed markets, and growth stocks. This graph shows these valuation discounts have been accumulating over a considerable period of time. It's not really just about the coronavirus meltdown of 2020 suppressing valuations, but over the last decade or so, all three of these groups have lost share to their counterparts. As you can see in this graph, we've normalized price-to-book multiples across the spectrum of equity markets to get a sense for where multiples are trading. By the time small caps reached their low in early 2020, they were trading at 50% of their usual discount to large cap stocks. A tremendous opening of valuation gap had occurred. Likewise, value stocks have just seen constant depletion in valuations over the course of the last 10 years, to the point where at their low in 2020, they were trading more than 2 standard deviations below the norm. And emerging market equities, of course, reached a point in 2020 where they were trading at roughly 2001 levels relative to developed markets. So the valuation gaps that emerged over the course of the last several years do set a really constructive backdrop for rotation. Clearly, we need a catalyst for rotation into these groups, though, and we see that catalyst as several-fold. First, the earnings landscape is improving materially for these segments of the equity markets. As you can see in this next exhibit, small cap earnings growth should outpace large cap earnings growth. Indeed, small cap stocks should post earnings growth that surpasses large cap stocks growth for the first time since 2017 in the year ahead. Likewise, emerging market stocks growth should truly crush developed markets growth in earnings over the course of 2021, at least according to Bloomberg consensus estimates. And then, of course, value stocks, which normally don't outpace growth, but we're anticipating they will outpace growth stocks EPS over the course of 2021. This constructive earnings backdrop is also supported by improving macroeconomic conditions for all three of these groups. Back in April 2020, our models suggested that we should get a little bit more optimistic about the outlook for small cap shares. The reason being, the monetary and fiscal policy landscape changed. This graph shows small caps relative to large cap stocks and their performance from 2020's low plotted next to their performance from 2009's low. You can see that the graphs are really moving closely, hand in hand, and this is not coincidental. Back in 2009, you may recall, the Federal Reserve's balance sheet expanded by 85% over the course of the next 5 years as the Fed embarked upon the then experimental quantitative easing program. The Fed balance sheet already has expanded by 75% over just the course of the last year. Likewise, in 2009, we saw the American Reinvestment and Recovery Act add another $800 billion to the economic landscape through federal fiscal stimulus. In 2020, we saw $3 trillion of spending emerge, and we likely will see more into 2021. This combination of very supportive monetary and fiscal policy in 2020 compares quite closely to 2009 and may imply an enduring period of outperformance for small caps is starting to emerge. The macroeconomic landscape for value stocks is equally as supportive. We find that a few factors really drive value performance relative to growth, all of which have been somewhat suppressed over the course of the last 10 years, but we might be at a turning point. Interest rates and commodity prices are those two strong drivers of value performance. Over time, as you can see in this exhibit, value stocks are very positively correlated with long-term interest yields, or the yields on the 10-year Treasury. As long as 10-year Treasury yields are rising, value stocks tend to perform reasonably well relative to growth. But in an environment where 10-year Treasury yields were falling, as has been the case really for the better part of a decade, value stocks struggle. Over the last year, we've seen interest rates start to rise, and we think that we're likely to see continuous gains in interest rates reflecting an improvement in economic conditions and emerging inflation pressures. This should help value stocks considerably. Likewise, commodity prices are a huge input for value performance. When energy prices, agriculture prices, and metals prices are rising, value stocks tend to perform reasonably well. Part of this is the inflation issue that we just discussed with respect to yields. But part of it is also that 30% of the market cap of the value index is somewhat levered to rising commodity prices. That includes energy stocks, material stocks, industrial stocks, and utility stocks, which make an outsized share of value. Finally, and certainly last but not least, is the emerging market theme. Over the last decade, emerging markets have really struggled relative to developed market stocks, especially relative to U.S. stocks. Part of the reason for that is certainly the dollar. In an environment in which risk tolerance is improving, the dollar should decline. We started to see that in 2020, and we should continue to see that in 2021 as risk tolerance starts to normalize with the return to work, with the return to economic growth conditions. As this graph shows, the two move very closely together and in opposite. When the dollar declines, emerging market stocks do well, and vice versa. In the 2008 to 2016 time period, when emerging markets really struggled relative to developed markets, the dollar rallied 40%. Again, in 2018 to 2020, the dollar rallied on really unpredictable trade policy and its likely dampening effect on economic growth. But the dollar turnaround has contributed to sudden signs of life in emerging market stocks. This was triggered first by our global scorecard back in May, and the scorecard continues to point to opportunities in emerging market equities. For more, feel free to visit us on your terminal at BI_STOX-GO or go to BIGO for all of your research needs. Thanks so much for joining me, and enjoy the rest of your conference.
Welcome to the next installment of Bloomberg The Year Ahead. I'm David Weston. We're delighted to be joined right now by Jeff Blau. He is the CEO of the Related Companies. It is the largest landlord in the New York City area. It is one of the most prominent real estate developers in the country and indeed around the world. Jeff, thank you so much for joining us.
Good to be here, David. Good to see you.
So let me ask you the most basic question I think is on an awful lot of our minds. What is it going to take to get people back into the offices in New York City?
I mean, it's an interesting question, David. The two obvious answers are vaccine rollout, but probably even more critical right now is testing. We all thought after New Year's that everyone would return right back to the office, but in an interesting twist, I have a feeling that the vaccine announcement and the closeness of it has really enabled companies to just say, I'm gonna just wait. It's so close. I'm not going to pull everyone back to the office yet. Unfortunately, in New York, office actual occupancy, people showing up at their desk every day, is under 10%. And it's critical that we kind of really push testing, make people feel safe and comfortable until they ultimately do get vaccine, so people come back to the office. If people don't come back to the office, New York cannot recover. And that's really the sad thing that's happening now. Our restaurants are closing, small businesses are closing, and just if you walk around Midtown, people aren't here. And so it is critical. I do think that the rapid test is getting cheaper and more effective, and so that will help. But I think it's going to be slow going until kind of a real vaccine rollout.
What can companies that own and or manage these properties do to expedite that? I mean, for example, does it make sense for them to put rapid testing into their own buildings?
Right. So in partnership with the governor, Governor Cuomo here in New York, what we've done and what he really put out was every building, he wants to create, in effect, COVID-safe buildings. And so, for example, what we've done here at Hudson Yards is, in partnership with Mount Sinai, we've created a testing center. So every one of our tenants has access to this testing center, or they can come onto an employer's own premises. So that's what we do here at Related. So every week, Mount Sinai comes in and every single employee gets tested once a week. And in the buildings, any guest that wants to come into the building goes through a rapid test program. And so those two things will enable us to call this a COVID-safe place. And so we're managing it that way. And I think the more people can do that and roll out that type of testing protocol, I think people will feel safer and more comfortable about coming back to work. And that's really what it's going to take.
One of the things we're very conscious of in New York, obviously, are the financial organizations. Do you have a sense of companies in Wall Street, how eager they are to get their people back in?
I'd say it varies. I mean, I'm sure you've heard David Solomon really encouraging at Goldman to encourage his employees to get back. He had a very funny quote. He kind of said, well, sure, you guys all want to work home from your living room, and you can do that until your competitor shows up in person and wins an assignment. You guys need to get back to the office, right? So I do think that there is pressure. The market will ultimately bring pressure for people to come back. It's interesting. You hear a lot about tech tenants or CEOs saying, I'm going to let my employees just work from home till June or December or forever in some cases. And yet behind the scenes, when you talk to them, and I spend a lot of my time doing exactly that, really trying to understand what their plans are, they realize that this doesn't work from a long-term perspective. They realize that culture does not work. It is not created over Zoom, over Skype, or whatever we're using today. And interactions happen in the hallway, and you bump into each other. I know certainly here at Related, that's how we work. It's a little bit less formal, and our best meetings just occur when you walk down the hall and see somebody. And it's hard to create that on Zoom. You can't schedule that interaction. How do you train new people? You have an incoming class of analysts. Goldman has 2,500 new analysts come in, and what are they supposed to do on Zoom? So I ultimately do think, I think the long run answer here is that there will be more flexibility in the workplace. I think that employees value the ability to work from home a portion of the time. If you divide a person's day into the bump into a hall, an interactive meeting, and writing an investment memo, which they can do by themselves, maybe there's a way to divide that work up. And I'm just using this, the investment memo writing actually happens, on Friday at home. And the rest is, but it also needs to be a coordinated day, because if you have people randomly showing up and not showing up, then that interaction doesn't happen either. So in speaking to some of the tech companies, that's what I'm hearing as a potential outcome of this. They might be that this group says on Thursday, we're going to have work from home day. but everybody else, and it has to be the same day. So then everybody's out. And then the rest of the time, everyone interacts together. So I really do think people want to get back to the office for culture, for training, and quite honestly, for just socialization.
In that world of more flexibility, as you call it, does that affect the long-term demand for commercial real estate as a practical matter? Are you looking at a different curve out in the out years?
I don't really think so, because ultimately you still need, for those days that you're coming in, people to have an office. What I think might happen is that the build out of space might change. So there might be more meeting rooms, more conference facilities, more auditoriums, and smaller, certainly private offices, and maybe more open cube type seating. So I think it's going to change. I don't think it will really affect the overall demand.
Are you seeing a shift in your own business between commercial on the one hand and residential on the other? And particularly when it comes to some of the big luxury malls, you have a really big one there at Hudson Yards. Are you shifting your use at that massive project down at Hudson Yards?
Yes. So we spent a lot of time thinking about the future of real estate development in response to the pandemic, but also just over time, everything evolves. And actually, if you think about Hudson Yards, it really had many of the features that we think are critical today. I mean, the words that people like to say today are 15-minute cities. Well, what does that really mean? It means that you want basically everything. You could work your whole day or spend your whole day within a 15-minute walk. So it goes back to kind of the live, work, play nature of the way we've been designing our mixed-use developments. So you think about Hudson Yards here. We have office, retail, residential. Retail, as you said. Yes. Is there too much retail in many of these things today? Yes. And we are converting a former Neiman Marcus space into 420,000 square feet of incredible office space, because there is demand for office and less demand for retail. We're about to launch a new mixed-use development in Santa Clara, right in the middle of Silicon Valley. People say, well, does it make sense to start new development today? But think about the winners. Nobody's a winner from COVID, but people that did well through COVID, and it's all the tech companies, right? So we have 250 acres right across from the 49ers Stadium in Santa Clara, surrounded by 75 corporate headquarters of tech companies, right? All those companies have grown in the past year and all demanding space. And so we're designing the mixed-use development of the future for those type of tenants that did do well, are expanding, do need space. This will be the most sustainable mixed-use community ever built in America. It's the largest entitled development ever in the state of California. So it's very exciting. We're doing a similar development in London called Brent Cross Town. And so we're also, we've talked a lot about migration in and out of New York. We have a very large mixed-use development in West Palm Beach, similar kind of 15-minute city. So we're seeing a lot of new thinking around development, and optimistic.
I'm going to ask a lot of great questions of Jeff Blau, which is always a pleasure, but you can ask some questions too. You can put them in the chat and I'll do my best to work them in. Jeff, what about here in New York City? What do you need from the government? Federal government, state government, local government?
Right. Well, we've all watched the federal government, and I think it's a little bit of breath of fresh air. The interesting thing just to watch is that so much is actually getting done. So you just see that someone wasn't doing their job the day before. Forget about ideology or you liked them or you didn't like them. Things weren't getting done. So you look at it today. Every day we see a new executive order, a new bill, a new assignment, and I think it's been a refreshing movement in Washington. I think that the team that's been hired is very talented, and we're all optimistic about the future of Washington. But I think what's very important right now is that from a civic engagement perspective, everyone was so focused on the national politics. We need to really focus on our state and local elections. Here in New York, we have an upcoming mayoral race, and I think there's never been a more important race on a local level. If you look at New York and San Francisco, politics it's been a difficult leadership environment in both of these cities, and I think both of these cities have suffered because of that. The unfortunate thing here in New York is we have a voting system that only allows, essentially the next mayor will be elected in the Democratic primary as opposed to the general election. 70% of New Yorkers are registered Democrats. So Not many people know that, and not many people come out and vote in the Democratic primary. So that primary is June 22nd, as opposed to the general, which is in November. But what people don't know, in order to vote in the Democratic primary in June, you have to be a registered Democrat by February 14th. That's only 3 weeks from now. There's no real mention of that. As a result, in our last election, only 3% of New Yorkers voted for our current mayor and put him in office for 8 years. 3% of New Yorkers. So we have really gone out and on a campaign to register as many Democrats, not because of ideology. You can register back the next day, but because we want everyone to have a say in the election. We want everyone to vote and have their vote count. So we're trying to get that message out, and I've personally been spending a lot of time on that and really pushing a get out the vote initiative. And I think the majority of New Yorkers want a more moderate leader, but the majority of New Yorkers are not voting. And so you often get these extreme views in our electorate.
You were very careful to say not for ideological reasons. Has the attitude of business leaders shifted in light of what happened, frankly, down at the Capitol just before the inauguration? We saw some businesses who had contributed to some of the people who had, for example, resisted the Electoral College tally. Some companies now are really pulling back from that, saying we better stay out of this, at least for the time being. Do you think there's been a shift in the attitude of business leaders toward making political contributions?
Well, there certainly has, factually. Look, the reason I say that is because I think that you can make a pure statement when you're asking people to get out and vote. I think that's a civic responsibility. I think it's civic engagement. And my personal view is that the majority of New Yorkers are centrist and moderate. And so the more people we get to vote, maybe we'll get the outcome that reflects the majority. So I think if you start imposing personal viewpoints on ideology or parties, then you're tainting the Get Out the Vote initiative. And so I've been very careful really just to focus on Get Out the Vote.
Jeff, President Biden has really embraced climate as a major issue for his entire administration, a series of executive orders, appointments, things like that. Tell us how your business is shifting because of the need to address climate issues.
Right. So, I mean, personally, I think there's nothing more important. We've been on this issue for decades now here at Related. It's part of our DNA. It's integrated into all the buildings. We were really the first to take advantage of when the LEED rules were first developed. We built the first residential LEED building. Every one of our buildings today are LEED Gold or Platinum or even exceed that. But more important, we build sustainable cities. We build cogeneration plants, wastewater renewal. And so we're very active in this. And as we think about our developments of the future, we push the envelope even more. As I said, Santa Clara, we believe, will be the most sustainable mixed-use development ever built in the United States. We also more recently started an affiliate company, Energy Re, and that company is in the business of generation of wind and solar assets, in particular upstate New York, where land is cheap, and we will bring that power into New York City through new transmission lines, cleaning up the grid in New York, which at the moment is 80% fossil fuel and 20% renewable, and the goal is to really move that. Upstate, it's the exact opposite. It's 80% renewable and 20% fossil fuels, but there's no way to get the renewable energy upstate, downstate. And so this transmission line project that we're working on can help solve that problem. And we think it's critical for the future of cities to really focus on bringing clean energy into the cities so that the buildings, essentially what happened and why we went on this mission is we made these buildings so tight that there's really nothing we could do to further reduce carbon emission or reduce energy consumption. What we really need to do is change the source of energy to renewables. And so that's been our focus, and we think there's a big business there. We just cut out. Lindsay.
Okay, we're back now with Jeff Blau. He's the CEO of Related Companies. I apologize for the technical problems. So, Jeff, we have just a couple of minutes left here, but I really wanted to ask you what the future of New York City is, for that matter of cities generally, given the work from home. And I guess simply put, are we all going to move to Florida?
I don't think we're all going to move to Florida. I think we have to look. We're in the moment right now. We're in the moment. We're in the middle of a pandemic. People are scared. People aren't going to the office. You walk down the streets, it's empty. Restaurants are closed. All the reasons why we came to New York are closed, right? But they're going to come back, right? We are going to have a vaccine. This will end. Restaurants are going to reopen. Culture will open. All the reasons that people came to New York are going to exist again, and I think people will stay in New York. Sure, some people are going to go to Florida. I'd say they're going to Florida more because of taxes than anything else. And so we're building some new office buildings in Florida to help those people. But I think the big cities will survive. It's been a movement for decades. I don't think it's going to change. I think the mindset, as soon as this is over, is going to be kind of back to the roaring 20s, restaurants and going out and partying and kind of back to all the great things that New York has to offer.
And what about Related? Are you shifting more toward Florida? You mentioned earlier West Palm Beach. You have a couple at least of office buildings out there. Do you envision more investment in Florida over the longer term?
We are. It's not just Florida either. So yes, we have a very large mixed-use development in West Palm. We've been building in Florida all across the state for decades. We will continue that, and I do think there will be more business to be done there. We're also looking at, for us, non-traditional cities. We're building an office building in Dallas and Austin, Texas. I think Texas is going to be a big growth state. And then some of the smaller markets, Nashville, I think, is actually going to boom. Also different areas. I think life science is going to be a big focus for us. Last mile urban industrial, I think, is a core competency that we have and something that we're going to focus on. So the business is going to change, no question. But I'm optimistic about the future. I'm optimistic about New York, and looking forward to kind of all the great things to come.
How much of this was going to happen anyway, and how much of it is really specifically because of the pandemic?
I think almost everything I just said to you in terms of cities, product types, sustainability was already we were already on a path. It's certainly, this has been a major acceleration. It could have been a decade of acceleration. So, but we as a company have already kind of seen these things. We've already started down these paths, and so I think we are well positioned. We got a great team here to take advantage and really to grow in the future.
And how do your investors feel? Are they patient?
They are feeling, and they're certainly patient in our existing assets. I'm not sure there's much they could do about it right now. I think they are opportunistic in terms of kind of where the markets are going. I think more and more investors are looking to move into real assets and move into real estate as a big component of their investing strategy. And so the question is, where do they go? And I think it's going to be those cities we talked about and those different asset types that we talked about. But the investors have been patient, and actually, for the most part, they're doing great.
Okay, Jeff, really appreciate your time and your patience, actually. Thank you so much. That's Jeff Blau. He is the CEO of Related Companies, the largest landlord in the New York City area. And I apologize once again to our viewers for the technical problems, and thank you for your patience as well. This is The Year Ahead from Bloomberg, and I am David Weston.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials, find people, analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Hey everybody, I'm Alex Steele, Bloomberg Television, and I'm joined by John Gray, President and COO of Blackstone. He really needs no introduction, but I gave him one anyway. John, it's good to talk to you. First off, how are you? How you doing?
I'm doing fine, Alex. It's obviously been a difficult period for lots of people, but I'm happy to be here.
And we're really happy to talk to you. There's a lot to get through, but I do want to start with the craziness that we're seeing in the market with the Reddit guys and the hedge funds and the short covering and the volatility. You've seen a lot of stuff. This is new. What do you think about it?
Well, we tend to be long-term investors. And so we look at things over a period of time and we try to analyze companies and figure out their value, their cash flows, their growth prospects. And what you're watching now is obviously something that's very different. And what concerns me is when asset values decouple from their underlying value. And that becomes a challenge because at some point we know from history they will converge. And that's what I think is likely to happen over time. And I worry a bit about what happens with individual investors who are participating. I would recommend trying to take that long-term view with investing.
And at the same time, I mean, you guys do have positions in hedge funds. I mean, some of the moves we've seen for hedge funds have been extreme in the last few weeks. Some actually have to get cash infusions. Are you worried about your exposure there at all?
Fortunately for us, it's not material to our hedge fund solutions business, but there have been hedge funds hit. And I think one of the lessons here, again, is how much leverage hedge funds operate with. Because what happens is in a crisis, it can be like the pandemic, it can be a natural event, or it can be something like this. When you have short duration debt and there's a big spike, you can lose your assets, even if things are moving, in the wrong way for a period of time. And I think that's really the takeaway from this situation.
I feel like crash up is something that can be coined, right? We're used to crashing down. This is like a crash up. Something that obviously, and this kind of pairs with 2021 and the Biden administration, we're seeing more calls for that now regulation. Things like leverage, things like how many short positions someone can hold. Like, what do you think the evolution of this will become?
Well, I don't know. Regulators are obviously going to take a look. On the one hand, you can't discourage individual investors from making investments they want to make in the market. The question is, are folks trying to guide things to generate short-term gains? I think there will be more scrutiny. When they look at leverage, the question is, are there systemic risks? I don't think there are from this. So from that standpoint, they're just people taking losses. But as we move into this sort of new distributed social media-led world, it creates new challenges for all of us, I think regulators in particular.
Yeah, and it really also highlights, I mean, there's one article in the FT today about how this is the next iteration of the Wall Street protests that we saw years ago and sets up a Wall Street versus Main Street. How do you at Blackstone tackle that narrative?
I'm not sure, and I don't know. Some of this may be Wall Street versus Main Street. Some of this may be just traditional greed, people trying to, tulips rise up, people go after things as prices rise. But there could certainly be this element of the small person versus Wall Street. For us, again, our approach is we're stewards of capital long term. We raise capital from our investors. We try to invest in things we believe in. We try to add value and generate favorable returns. I think that is a much more sound approach to investing, and we try not to get caught up in the heat of the day.
That's fair. All right, you just had earnings yesterday. I mean, you had really stellar numbers. If you were to look ahead to 2021, what do you think we're going to be talking about in a year?
Well, that's interesting. Yeah, no, we had a terrific quarter, and we were excited about that. Obviously, we had great returns for our investors and delivered really terrific earnings, and we saw a lot of inflows. And it was on the back of some good decisions we made in deploying capital and a lot of growth we're seeing across the firm. As we look forward, I think a year from now, we'll be talking more about an economy that has reopened and has tremendous strength. I think it's hard for us. We were just talking off air about this feeling of being trapped at home that so many people have. People want to get out. And so there's sort of a global cabin fever phenomena that I think is going to reverse itself when we get back out. People are going to take planes, they're going to get in cars, they're going to go places, they're going to go to restaurants, they're going to go to ball games. Consumer savings are at record levels. Credit card debt has been paid down. And so I think we could see a surge of economic activity in the second half of the year in a post-pandemic world. Now, for investors, I think what's interesting is you may see commodity prices go up. You could see wages go up, which is obviously good for lots of people, but we could see inflation higher and the long end of the yield curve go up. In China today, the long end is back to where it was prior to the crisis, which is not a surprise given their economy is mostly reopened. And when that happens, it could impact asset values. So I think what we may be talking about next year is, whereas 2020 was the year markets moved well ahead of the economy, the back half of 21 could be a period where the economy moves ahead of the markets.
That's a really interesting way of phrasing it. And I wonder, we're all trying to figure out, like, what is that level on the 10-year or the yield curve that's going to wind up affecting asset prices?
You know, it's very hard to say. I don't know, but obviously, if the 10-year went from 1 to 2, that's a pretty dramatic move. I think the most vulnerable assets would be long duration fixed income because there's not a lot to hide. If you bought a bond that yields less than 2% and the 10-year goes there. For companies, it'll be a mixed story. Some companies will get a real pickup in business activity. But others that are more bond-like, there could be a little more risk associated with them. So, you know, I think it's hard to say. I'm not necessarily saying, you know, calling for a sharp decline in markets. I'm just saying that, you know, we benefited from this great stimulus and very accommodated policy and very low rates. And some of that, certainly at the long end, could go away and it could impact values.
So then it's like a two-for question. What assets would you are immune from that you guys are investing in? And if there is a decline in asset prices that's material, kind of what's on your shopping list?
So I would say generally, maybe I'll answer them both together. Where are we looking? I'd say one place is COVID impacted businesses that we think will recover sharply. So if you buy into my scenario, you'd want to own transportation infrastructure, rail, roads, airports. You'd want to own location-based entertainment. We own a water park business. People want to take their kids back out. You'd want to buy hotels. We've been big investors in hotels over time. I think you'd also be more inclined to own shorter duration floating rate debt. We like that in the private markets where you get a little bit more spread. And then I would say more broadly, and this has been going on with us for a number of years, there are still these big economic changes driven mostly by technology that I still think you want exposure around. So goods are moving increasingly online. And we've been the largest buyer of global logistics. Today, we own $100 billion. It's our biggest exposure at the firm, particularly around what we call last mile warehouses. We bought some assets in China recently. We did a deal in Southern California. We like that. Content is moving online. Video games, movies, music. We just bought a video game online advertising business. We bought a bunch of studios in Hollywood. Cloud migration, software moving to the cloud. That's something we continue to like. We've done a number of things in enterprise software. You need the digital infrastructure to back this up. So the data centers, the fiber, the towers. I would also add this big push into green will continue. And today in the stock market, some of those stocks have run quite a bit. But the overall trend going from less than 10% sustainable energy sources to a much higher percentage over the next 20, 30 years means huge need for capital across wind and water and solar and battery power. And those are areas that are interesting. And then I'd say life sciences is another area that we're enthused about. It's been our biggest theme. We've sort of done it beaker to bedside. We've done it in places like life science office buildings. We just bought a big portfolio in Cambridge, Massachusetts. We've done it in commercializing life science therapies. We've done it investing in individual drugs that treat cancer, bladder cancer, kidney disease, diabetes. So we're spending lots of time in that area. And then the one other thing I'd say about some of these themes is they're not all technology driven. Aging populations will continue. We've played that in Japan with over-the-counter drugs and generic pharmaceuticals. Rising middle class in places like China and India. There we've invested in things like education and consumer finance. And then alternatives, the sector we're in today, continues to have a big boost, and we invest in secondaries and stakes in managers. So it's obviously not an easy time to invest capital, but I do think looking at these big thematic changes happening in the world makes it an easier way to invest.
So that's actually a good segue to this question that we got from a viewer saying the U.S. economy shrank by 3.5% last year, the worst year for growth since World War II. What will building back the U.S. look like? And in particular, how will young people and the future of our workforce be impacted? And I think that also builds on a theme of the migration we've seen out of cities. You have been bullish on cities like Tennessee, Nashville, Austin, et cetera. I know you guys are starting a tech branch in Miami. How do you see all the chess pieces?
Well, I do think lots of things will go back to the way they were. I do think many of us are going to go back to offices. I think about our company today. We have a subset of us here. We've been able to do that through testing, contact tracing, paying for people's transportation, and we do it on a voluntary basis. But having people in the office together makes us more productive. It allows us to interact, call people together. Today, we do it in masks in a conference room, but that's really helpful. Training young people, I think, is virtually impossible in a Zoom world. It's a great technology when you've worked together for a long time and you have a lot of social capital. But for a young person who just is getting a job, to be in the office, to lean over to the cube next to them, I think that's really important. So I do think we'll mostly go back to office. Some functions will be done in maybe a hybrid role, so there may be some decreased demand for office space, but overall, I think people will come back together. And then to your question of where will they go, I still think urbanization continues. I think the big cities will recover. New York City is going to come back. I know its demise is talked about quite a bit, but this city is going to come back. There's so much energy here. I think about my daughters leaving college with their friends. They're all at home. They want to rent apartments and start their lives. They want to come to New York City. So I think a city like New York will come back, but there are some headwinds here, no question about it. Issues around the cost of living, taxes. People have now experienced living in places like Austin or Miami. So that's a headwind. And some of those cities will benefit, no question about it, where you'll see movement to Nashville and Austin, Salt Lake City, Raleigh, Durham, Miami. But I think urbanization overall will continue. The big cities will come back. They do have to make good decisions, I think, policy-wise, over time here, which is a challenge. But some of these emerging cities will have a lot of momentum. So I don't think this will end up all of us living in suburban and rural areas. And the trends globally towards urbanization, I think, continue.
So quick question on that before I ask you a question about Miami. So I know we're talking about residential, but then when do you see sort of the bottom in commercial real estate prices in some of the hubs that are getting hit hard, like in New York?
So real estate tends to lag. I think apartment values are probably, will probably bottom out here at some point fairly soon, because I think people are going to start moving back in to the cities, which will help the apartments. The office market takes time. Companies are now uncertain about their future. What are they going to do? How many people will be in the office? Vacancy rates in places like San Francisco have gone from 10% to 20%. You guys had an article about London, the sharp increase in vacancy there. So I think that will take some time, but ultimately there'll be a recovery. There'll end up being less building of new office buildings around the world. The existing buildings will absorb the space. It may take a number of years, but we're probably not necessarily at the bottom for valuations yet, or the bottom for the rental markets here. That maybe they've sort of bottomed and maybe we plateau at this level for some time.
Do we need to get to like herd immunity to call a bottom? Or, I mean, is it just, how does that recovery play out?
Well, herd immunity definitely is going to get people back in the cities, get confidence back, leasing activity. The apartment buildings will fill up. Certainly the hotels will come back today. Many of the hotels are closed in these places. And then the office buildings will take time. I think what will happen is some companies will come back. They'll find that, wow, this is good, being in the office, talking to the person next to me, for culture, for integration. For us, we view our business as a team sport, the way we do it. And I think that will lead more companies to come back into the office, and that'll lead to a recovery. So, yeah, I would be willing to make bets certainly around these urban centers and buying assets at prices that are down from where they were prior to the crisis.
Are you going to be buying a house in Miami like everybody else?
I don't have any plans today to do that. But I think Miami's got a lot of tailwind. We actually chose Miami as a second location for our tech group when we were looking for another location that had good quality of life and we could attract diverse talent. And Miami really hit the radar for us, and we decided to set up an office there. It doesn't mean we're moving from New York, but we are going to have more people down there in the tech space. We think that's a good thing for our business over time. We're obviously, as a firm, growing fairly rapidly.
Well, this actually ties into the next question from the audience. The question is, what are the top 3 investment opportunities the pandemic has thrown up, which I think is a pretty funny way of phrasing that. Are there new areas of investment that we might not otherwise have paid attention to? Miami was already a thing, but it became much more of a thing. But it is a good question, something that has happened that you weren't expecting.
Well, I think the biggest thing is the acceleration of these technologies we talked about, which is, sort of the Zoom world we're living in. By the way, climate would be a great example. People had talked about the risk for vaccines for a long time, the risk of a pandemic, the need to create vaccines, the need to be prepared. And we ended up as a society around the world paying the price. And I think this has now created more urgency around climate. So I think there's been a real acceleration in that area. Back to my earlier comments, clearly sort of this movement from offline to online of almost everything we do in our daily lives, I think will continue and accelerate. I think it will also accelerate things like digital payments in a huge way. I mean, something like 77% of transactions globally are still done by cash and check. And when you throw in credit cards, digital payments are a tiny percentage. We've all learned we can pay for lots of things doing this. I think telemedicine is probably the biggest winner or one of the big winners coming out of this. Before, because of privacy rules, health insurers and doctors, everyone was nervous. Now so many of us are having doctor's appointments. That's an area. So again, I go back to what's changed in our lives. We're probably less likely to watch movies in a movie theater. We're more likely to now stream that. What's become a permanent sort of acceleration and secular change as opposed to something that's cyclical. On the flip side, I think, how many pet houses, how much soup can we make at home? There are some activities, cooking or eating out had been, climbing for 30 years. And then we've seen this massive decline and huge surge in home cooking. That's probably not going to continue. And so you want to try to separate the cyclical from the secular. And if you identify those trends, find attractive ways. And one other thing I'd say about that is some of the on-theme trends are very expensive in the public markets today. And what you love to do is find things that are sort of one derivative off. Something in the supply chain could be compliance related to that growing trend. That's a way to play these things. It's not necessarily the direct software or app itself.
That's such a good point. We only have like a minute and a half left, and I did really want to get to climate, because something that we might see from Biden administration would be more clarity on like what ESG actually is and better disclosure from companies, which would help investors like you. And I'm just wondering, like, it's been so popular, and we talked about how some of like the solar stocks really ran into Biden. What is that derivative right now in the climate investment story?
Well, for us, it's obviously looking in the private market. So finding companies, particularly growth companies that need capital, companies, the battery space we really like. We invested in a company out of our energy fund. We've invested in some companies doing things around building management systems and energy efficiency. And then there are folks that are in that supply chain manufacturing some of this. I would also throw in there utilities. If you think about utilities today, what they do is mostly off of hydrocarbons. Still, many of them rely on coal. Over time, they're going to have to invest significant capital to become green, and they get a guaranteed return on that capital they invest. And so that's an interesting derivative play to what's going to come, we think, in renewables.
Oh, really good point. Do you think that Biden needs to sort of lay out some more clarity on what disclosures are and definitions? Like, would that help you at all?
Well, I think you've got to give the administration a little bit of time. They've got a lot in front of them. The crisis, the pandemic is obviously a massive issue. I think they're very focused. They've got a number of people in the administration who've commented on this area. The president himself has made a number of very strong statements. I'd expect that there'll be more, and I'm sure it'll be around all sorts of things in energy efficiency, new building standards. I think this is coming really not only here in the U.S., but around the globe. We're seeing it, and this is a mega trend. And as I said, hydrocarbon usage will go down. It's not going away. It's going to take a long time, and that energy infrastructure will stay. But as investors, you want to think about, how can I benefit from this coming transformation?
Okay, fair. They got other stuff to do first. Okay, fine. All right, John, thanks a lot. I really appreciate it. It was good to catch up with you. John Gray joining me from Blackstone.
Thank you, Alex.
Thank you all for joining us for this session of the Year Ahead. We hope that you have enjoyed these conversations. Thanks again to all of our speakers and my colleagues serving as moderators for these wonderful conversations. And also thank you to our sponsors, Alex Partners and IBM, for their support in making this event possible. And most of all, thank you for being such an engaged audience. To rewatch any part of this event, you can come back to this website where the recordings will be uploaded. You can also access videos of all interviews on Bloomberg Live's page on YouTube. The Year Ahead continues this afternoon at 12 noon Eastern. You can check out our agenda on BloombergLive.com, and we certainly hope that you will come back and join us. I'll see you there shortly.